Stocks, ETFs, bonds, mutual funds, index funds, the pros and cons of each investment method. Investing is a way to grow your money over time. There are many different ways to invest, but not all of them are right for everyone. You should always consider your risk tolerance, as well as the amount of time you have, before you need to use the invested funds. The 5 main types of investments that we are going to talk about today are stocks, ETFs, bonds, index funds, and mutual funds. Each investment method has its own pros and cons, so it's important to do your research before you start investing. Investing is an activity that requires a lot of research and understanding. Now, if you are enjoying this video, please don't forget to smash the like button and subscribe for more videos like this. Also, make sure you click on the bell to turn on notifications. The pros and cons of stock investment method. Stocks are the most volatile investment vehicle out there, and they offer the potential for the highest returns. If you're looking for a quick way to grow your money and have a high risk tolerance, stocks are probably the best option for you. However, if you're looking for safety and stability, stocks might not be the best investment vehicle for you. Stocks are considered the most risky type of investment because, despite offering the potential for greater returns, they have a higher chance of losing money compared to other methods. For example, if you invest in stocks, you might make a lot more money than if you invested in bonds, but there is also the risk that your investments will lose all their value. If you have a long-term investment horizon, and you're comfortable with some degree of risk, then stocks can be a good option for you. The pros of investing in stocks. With stocks, you have the chance to diversify your portfolio by investing in stocks of different sectors. You have the opportunity to be more involved in your investments. It is a low-cost way of investing. You have the potential for greater returns. You can invest as little as you want. You have more control over your investments because you can buy and sell stocks at any time during open market and also after hours. The cons of investing in stocks. It's not very safe because the market is unpredictable. The market can crash anytime. Sometimes companies go bankrupt, which means your shares will be worthless if this happens. There are no guarantees on how much money you will make, and it's possible for your investment to lose value over time due to a company not performing as expected, etc. The pros and cons of ETFs investment method. If you don't want to take as much risk as investing in stocks, then you might want to go with an ETF. ETFs, exchange-traded funds, are a type of fund that invests in stocks, bonds, or commodities. They are traded on the stock market and can be bought and sold like stocks. ETFs offer diversification across asset classes, which reduces risk and volatility in the portfolio. ETFs are not for everyone, and they have their own pros and cons. The pros of investing in ETFs. ETFs are a low-cost way to invest in a diverse portfolio of stocks. They are generally cheaper than mutual funds. ETFs trade like stocks and can be traded at any time during the day, even after the markets are closed, in the after-hours market. They provide diversification. They tend to be less risky. ETFs generally tend to be more tax efficient than mutual funds or index funds. They usually have a lower minimum investment requirement. ETFs have higher liquidity than mutual funds. This means they are faster to cash in, once sold. They generally have lower expense ratios than index funds do. The cons of investing in ETFs. Some ETFs are not as liquid as stocks, so it may not be easy for an investor to buy or sell shares at a desirable price. Some ETFs may have higher management fees and trading costs than mutual funds or other investment options, which is why investors should always compare their options before making an investment decision. ETFs may not track as closely to an index as an index fund would. They provide limited control over the underlying investments. The pros and cons of bonds investment method. Bonds are a form of debt that is issued by governments, companies, and other entities to raise money. They are fixed interest securities that offer a lower risk than stocks, but provide a lower rate of return as well. Investing in bonds is a relatively low-risk way of generating income. The downside to this investment method is that you will earn less than what you would if you invested in stocks, but the trade-off is that your portfolio will be less volatile. Investing in bonds can be a good idea for people who are looking for a more stable income stream. The pros of investing in bonds. Bonds offer predictable income because they pay interest every 6 months or annually, as well as at maturity. They are more stable than stocks and they have less risk involved. This makes them better suited to people who want stability instead of high returns or who don't have a high risk tolerance. The interest rate on bonds is set when they are issued, so investors know what their return will be based on the risk taken. Bonds provide an opportunity to invest in assets without taking on many risks. Bonds are safer than stocks because they offer a fixed rate of return that never changes, even if the market crashes or goes up and down. The amount of interest you receive depends on the credit worthiness of the issuer. The cons of investing in bonds. You have to pay income tax on your interest income each year. Bonds offer lower returns than stocks. They also require more time and effort in order to be sold or traded in comparison to stocks. If you sell your bonds before they mature, you will either have to pay a penalty for early redemption or take a capital loss on the bonds. Bonds don't offer any growth potential. The pros and cons of mutual funds investment method. Mutual funds are a type of investment that pools together the money from many investors and invests it in stocks, bonds, and money market instruments. Mutual funds are a popular investment method that is used by many people. However, there are some pros and cons to this investment methodology. The pros of investing in mutual funds. Mutual funds can be a good choice for investors who want to make long-term investments, or who don't have the time or knowledge to manage their own portfolio. Mutual funds allow investors to diversify their investments across different sectors and industries, which helps in reducing risk. Investments in mutual funds are considered liquid, meaning you can withdraw your money whenever you want without incurring any penalties. All mutual fund orders are executed at the end of each trading day. The cons of investing in mutual funds. There may be fees associated with mutual fund transactions, which could include trading commissions, marketing fees, and other types of expenses that come with running the fund. The fees for mutual fund investments can be significantly higher than those for other types of investments. Investors have limited control over what securities are held in their account and when they will be sold. Taxes on mutual funds may be higher than taxes on other types of investments, because dividends and capital gains distributions may be treated as ordinary income. The pros and cons of index funds investment method. Index funds are a type of mutual fund that invests in stocks that are representative of a particular market or sector, and are bought and sold like stocks. They are often passively managed, meaning the investment manager does not actively trade within the fund. They are considered a low-cost way to invest because the investor doesn't have to pay for the cost of actively managing the portfolio. Index funds can be an effective way for investors to diversify their portfolios and save on fees. However, they have some drawbacks. The pros of investing in index funds. Index funds are generally passively managed, meaning that the fund manager does not make any decisions on which stocks to buy and sell. They are low cost because they don't employ expensive analysts, managers, or researchers. They have very low turnover rates, which is good for the investors, because it means they don't pay too many fees that otherwise would reduce the fund's overall performance. The index fund will always match the market's performance. They are a good option for investors who have a long-term goal and want to minimize risks. Index funds are less expensive than actively managed mutual funds. Index funds are more tax efficient than actively managed mutual funds. They offer low volatility with steady long-term returns. They are less likely to lose money during market downturns. Index funds offer diversification among many different securities in a single investment. This means that when one company within an index fund suffers losses, another company may be doing well and vice versa. The cons of investing in index funds. There is no guarantee that an index fund will outperform its benchmark index. Index funds have higher fees than other types of investment vehicles. Index funds are not tailored to the individual investor's needs. They can also be inflexible and may not perform as well as active investments in different market conditions. Index funds can be too passive for some people who want more control over their investments. They are not as liquid as other investment options, and they do not provide the same level of returns. As seen, There are many different ways to invest, and each one has its own pros and cons. The intention of this video is to help you better understand your options and any potential risks associated with them. It is important to always do your own research and due diligence before investing in the stock market. It is very easy to be swept up in the hype of a popular stock, or be fooled by a company's big announcement. Please don't forget to smash the like button, subscribe and click on the bell, it will help me a lot. Thank you for watching and I'll see you on the next video.